Risk units. Ever heard of them? What's up, everyone? This is Eric with Theme Options Trading, and we are in our 3-minute beginner series. And today we're going to talk about risk. Risk is something that is preached on a ton in the day trading realm, and it's for a good reason. It is one of the few controllables in the stock market. The stock market is full of uncertainty. You may have strong convictions that a trade is going to work in your favor, but these convictions will not happen 100% of the time. Risk is something you determine before a trade, and it is up to you to determine if you stick to this risk throughout the trade. When it comes to risk, there are two primary ways to view it: from a percentage standpoint or from a fixed standpoint. Let's first take a look at a percentage view on risk. And this view on risk is pretty common in system or mathematical based traders. Rather than have a fixed profit target, they look at percentage gain on the trade. Why is this appealing? Well, because of compound growth. So the gains are much larger when it comes to a percentage based risk approach. But flaw number one, what does this also mean? This also means your losses are much larger. And sometimes these losses are hard to swallow. Flaw number two, when it comes to trading options, there is a limit to liquidity. It is very different than trading equities or stocks. But as we should know by now, you don't need to trade with large size in options to make large gains. And that is one of the many reasons why I prefer option trading. Let's now look at the second approach to risk, or the fixed risk. It is a fixed number of risk on each trade. Why is this approach good? Because you can scale up this number as you feel comfortable. Let's say after 10 profitable trades in a row, you say, okay, great. I feel comfortable risking $100 on my account. Let's try to bump this up to $200 to see how I respond. It is directly in your control on when you increase this number or decrease it. It's based off of your comfort level. It's not forced because it's not looking at the percentage of your account. So how do you calculate R? Simple. Divide your profit by your risk. So if you have a $10,000 account and your account is up $5,000, well, 5,000 divided by 100, this means your account is up 50 R. Now let's look at a $100,000 account. Let's say you're up $5,000, but instead of risking $100 on each trade, you're risking $1,000 on each trade. What is your R profit, or your profit compared to risk units? Well, 5,000 divided by 1,000 is 5. This means this account is only up 5R. So comparing these two accounts, one is up 5R and the other is up 50R. Who's the better trader? The account that has a 50R worth of profit. And so as you grow your account, you always need to compare your profits and losses relative to your risk units, because the exact dollar amount only goes so far because it does not look at the risk itself. And as we should know, risk is the most important part of trading. And that's it. Thank you so much for watching. Please like this video and subscribe to my channel if you haven't already. Until next time.